While global stock markets are posting fresh record highs as investors switch between optimism and pessimism over a possible US-Iran peace deal. Strong corporate earnings and lower oil prices are both boosting sentiment. Iran has confirmed it's evaluating a US proposal for a deal that would reopen the vital Strait of Hormuz shipping route. Fiona Cincotta is an analyst with City Index in London. Fiona, lovely to chat to you. How much of this rally is based on solid data and how much of it is based on hope?
So there is definitely a mix going on here. So we are sort of moving towards the end of US earnings season, and it has in fact been a very strong earnings season. We're seeing earnings growth of around 25 to 27%, which is the strongest that we've seen since around Q4 of 2021. Also, data coming out of the US remains solid, so that's also encouraging. So on the back of those strong fundamentals, we are also seeing this optimism that a deal will be agreed soon between the US and Iran, and that's adding to this euphoria, which is helping stocks reach record levels.
All right, so we've got a bit of both. Optimism about a possible Iran peace deal and then also strong AI-related earnings. Which one matters more for the markets right now?
Well, because we're coming towards the end of earnings season, that's provided a really solid distraction for the markets, whilst there has been sort of these sort of toing and froings between the US and Iran over whether there is going to be a deal or no deal. So I think for going forward, what matters most is actually the US and Iran, because that still hasn't actually crossed the line, which means that it is potentially still a risk and things could still go wrong there. And if that does happen, then that does mean we could still see an unwinding of this sort of positive sentiment that we've seen. Whereas with the AI trade, we've had a lot of the earnings. We've obviously still got Nvidia to come, but I do feel that that's sort of been very much a support as far as the markets have been concerned so far.
We know the oil price is, I think, is still hovering around $100 a barrel, still elevated, but way off the $120 we saw earlier this week. If it pushed up that high again, do you think that could derail the equity rally?
I think it depends how long it goes up towards that level for, because we did see, not so long ago that oil prices did actually spike again, and the market reaction was actually fairly sanguine. So, I do think that it would need to be a prolonged move of oil prices above the sort of 110, 120 level in order for the market to get nervous again. But as you said, we have seen oil come down to around $100 a barrel. We're not expecting it to fall back towards that $60 a barrel anytime soon. But if we do see progress with a deal, then we could see it fall lower.
Fiona, where do you see it going from here? Could we see more records being broken, or do you think the market's going to sort of stabilize at some point?
I think there is a potential for there to be more gains to be had. As I said, we've got that solid earnings season that we're sort of coming towards the end of. The data has been strong. And then if we do see the end to this war with a deal signed between the US and, most importantly, the Strait of Hormuz reopened, then that could accelerate further gains. I think where we could start to see some concerns coming through is when inflation data does start to come through higher, and that will happen at some point. Obviously, we have seen a slight creep up in inflation already, but I think as we head towards Q3 and we see those higher oil prices feed into the real economy, that's when we're going to start to see those numbers move higher on inflation, which could just unnerve the market a little bit then.
Yeah, I was going to ask you about the inflation rate, because what we know about this crisis in the Strait of Hormuz is even if it opens tomorrow, the lag is going to last a very long time, even affecting fertilizer delivery, which is going to affect crops, which is going to affect the price of food. How long do you think we could be in for?
Yeah, so it depends again how quickly the Strait of Hormuz does reopen and how quickly we see vessels returning to flow through there. But I think, it's fair to say that even if it does open tomorrow, it will take a good couple of months for things to normalise. Now, in some way, that's not so bad, because we may see that central banks are going to take that transitionary approach to this inflation hit and not move as far as rates are concerned. The Federal Reserve, for example, we're not expecting them to hike rates rates, for example, at the moment, but definitely not cut rates either. So, you know, as long as we sort of do see an end to or the war and the reopening of that strait soon, I think we could potentially miss a very, very hard hit as far as rates are concerned. But we will still have a couple of uncomfortable months as far as inflation is concerned as we head towards Q3 and Q4.
Thanks for breaking all of that down for us. That's Fiona Cincotta of City Index.